Good afternoon, everyone, and welcome back to A Week in Markets, where we're going to have a UK focus this week. There's a lot to discuss. Before we begin, it's worth pointing out we've just had the US jobs data for the month of January. That's just hot off the press, and it's very much an inline print. The US economy continues to hum along. Jobs growth is healthy. Wages are around about 4%, which is very consistent with inflation returning to 2% in a timely fashion there. So let's move on and we'll discuss the UK. One point that we want to bring out through this conversation is that the stock market here, the FTSE 100, has again this week reached a new all-time high. Joe Forward has joined me from our investment analyst team. He's going to provide some context. Welcome, Joe. Let's start with the main event this week, which was the Bank of England yesterday. We had a rate cut, of course, but could you provide some context on why rates were cut and the revision to the forecast from the Bank of England?
Yeah, exactly. So as you mentioned, we got that quarter point cut, largely expected by the market, so not really surprised to us here in the office. I think there were two interesting elements to the cut. So one, we had the different monetary policy committee members voting. They essentially vote to decide where interest rates go. If we look at it, there was actually 7 of them decided on a quarter point cut, so that's why that came through. But then we had 2 of them actually decide on a half point cut.
Why do you think that is? So why did the 2 want a larger cut? What do you think they see that the rest of the committee don't?
So just in line with maybe some of the forecasts that we've had, there's maybe a slight change in focus more towards growth. So actually in the forecast that they provided, they expected the growth to reduce from 1.5% in 2025 down to 0.75%. So maybe just a few more fears that the focus is shifting from inflation to growth, essentially.
So that's a huge revision to the growth forecast, actually. Having the growth forecast in the space of just 3 months, I guess, as the reality of the budget sets in. You mentioned inflation, so there's a growth versus inflation balance. The growth forecast went down, but the inflation forecast went up, and that's probably going to be a challenge mostly for the Bank of England over the rest of the year.
Yeah, precisely. So that inflation forecast they actually mentioned that for Q3 in 2025, it's expected to hit around 3.7%. I would caveat that though slightly that it may be driven by some of the energy movements. So if you think of gas prices over the last couple of months, they've gone up around 20%-ish.
Yeah,
Oil
exactly.
also going up as well. So that may be driving some of those changes there.
And these are price pressures which are very much away from the influence of monetary policy here. It's the global markets which set these price pressures because these energy baskets trade in dollars. So it's a difficult job for the Bank of England. But it is worth the context there, Joe, that inflation dipped below 2% in June, but is effectively going to get close to 4% this year. Perhaps just as worryingly, the Bank of England now don't expect CPI to get back to target until early 2027. So there's going to be a long tail off in inflation if it does peak this year. So let's focus in on growth. Why has the growth forecast been slashed so much? Is it just to do with the budget?
Partially, I guess. But I mean, if you think about one of the elements of the budget was down to national insurance contributions from businesses. And another forecast they brought out was the unemployment forecast. Yep. And you actually saw an increase in that forecast to 4.8%. And essentially that's down to those businesses having maybe slightly higher costs down to possibly this national insurance contribution.
Yep.
And therefore maybe having to cut some of the staff, so softer labour market, feeding through into some of the growth projections.
So 3 pressures there. One is that unemployment is weakening. That is, we're seeing fewer and fewer people in jobs, and there's an early indication from the HMRC payrolls that there's actually job losses going through. There is the increase in cost for businesses, which you mentioned from the budget, so that's not just national insurance, but that's going to be the increase in the national living wage, which comes through in April. And perhaps the third most structural influence is that we've actually had one of the weakest recoveries in growth post-recession since the Second World War. So trend growth, underlying growth, was already very weak when Labour government came in, and it's now just set to weaken further. So there's a lot there to digest, but of course the stock market has looked through all of this, and we've actually, 2 weeks ago when I was in this very room giving the same presentation, it was an all-time high in the FTSE 100 then. We've had another new all-time high since, and that's despite worries about global tariffs, So what is driving the FTSE 100 and its performance?
Yeah, so companies are releasing their earnings for Q4, and what we really saw in Q4 in terms of currency moves was actually sterling and the euro weaken against the dollar. Now, a lot of these companies within particularly sort of Germany and Europe and also the UK, they generate a lot of their revenues abroad, globally. And so if you get that sort of translation effect, if you have sort of weaker sterling, weaker euro against the dollar, it means those revenues are actually boosted up. And so then you've also got global earnings increasing, so we've had growth, and if you look at sort of 2025 estimates, we're still getting, it's around 12% earnings growth estimates.
So a very strong global earnings cycle, and that obviously with, as you said, with the UK being dominated by corporates who get the majority of their earnings from overseas, that's a powerful tailwind for the stock market. A weaker sterling takes those dollar revenues and they are inflated in sterling terms, so that's another tailwind there. And of course, we're actually seeing some earnings revisions in the UK. So that is expectations for future earnings in the UK are being revised up. So three powerful tailwinds here. You mentioned Germany, very much the same type of dynamic there, which is global facing corporates who are basically getting their fair share of the profit cycle we're witnessing across the world. So a juxtaposed story there for you today, which is that a bit of doom and gloom in the economic forecasts for the UK. Probably a difficult message again for the Chancellor to come next month. The OBR are likely to have to slash their growth forecast, and of course that drives the fiscal budget of government. But as Joe has pointed out, reasons to be optimistic on the stock market. It's been a great month, a great start to the year for the FTSE 100 in particular. It's a real standout along with Germany in performance. And so we should be reassured that markets are able to look through the economic doom and gloom and deliver positive performance year to date. So that's all this week. Thank you for tuning in. Please enjoy your weekend and please do catch us next week for the Week in Markets. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.